Hey everyone, and welcome to Mortgage Minute Live, where we map out and navigate the road ahead with current housing market insights, trends, and new product updates. Today, we're here with our COO, Steve Remington. How are you post-Thanksgiving?
Happy post-Thanksgiving.
Yeah,
Glad to be here.
I know, I'm so happy you're here and moving into the last month of 2022. Can you believe it? Awesome. Well, let's start by navigating the road signs in the current market. Awesome. So up first on the docket today is the economic calendar. So talk to us a little bit about home prices and some data we've got coming out, what's expected.
Yeah, so compared to like last week or the week before, it was a little bit quiet, holiday week. So some important data, housing market data. We got the HPI Case-Shiller Index, which shows this continued trend of deceleration or a little bit of correction in the home prices. So you can see in the yellow highlight, the last about 4 or 5 months, we've seen that month over month drop. We're still not in some kind of massive sell-off, but this was one of the Fed's intended goals, was to cool off the overheated housing market. Two, that also helps with affordability. So as we can get back to a kind of a normal nominal home sale price, then it helps affordability. It helps buyers and sellers, come together, which right now a lot of people are sitting on the sidelines.
Yeah, it's nice to see a little bit of that happening.
Just a mild correction.
Yeah. Well, and we have had some calm waters in the mortgage market, so that's good. But where are interest rates sitting?
Yeah, so we've been a couple weeks since we had a Fed meeting and we had a CPI print. So mortgage rates are still stable. So we're down from the highs and we're holding that level. So the highs were in that kind of 7.4, 7.5 range. So the average conforming 30-year fix right now, as when I took this graph, was about 6.7. I heard a survey today, it was like 6.4, 6.5. So big change from sevens.
Yeah.
And so what does that mean to loan officers? So the 10-year stabilized at 3%, 3.7%. Mortgages right now are stabilized in kind of that mid sixes. So this rally from the mid sevens to the mid sixes has improved the rate sheets in some of these lower coupons. So the 6 and the 5.5 and 3, 5 3/4, 6, 6 1/4, those improved. One thing we're not seeing though is we're not seeing this return of capital to the premium pricing, the higher coupons. So your rate sheet might look a little different than you would expect. You can't just say, okay, well, the whole rate sheet got better by X amount. You really need to look at those, those kind of 6, 6 1/4, 5 3/4 interest rates and compare that to where it was 2 weeks ago, and you'll notice the difference. You may just have to sell a deal with 1 point origination or 1 point discount. That's what we're seeing the competitors do. We're getting a lot of calls from branches saying, hey, why aren't we, kind of seeing this improvement? And it's just really a function of that liquidity. So yes, you're seeing improvement in some of those lower interest rates, the 5 to 6.5. We're just not seeing improvement in the 6.5, 6 3/4, and 7 that you would expect to see in that kind of situation.
Awesome. Lastly, tell us a little bit about the current projections that you know about for Fed moves. I know that we've got a meeting coming up in 2 weeks, and inflation data that's coming out is going to make or break some situations.
This is that cool period where we have 2 CPI prints in between the two Fed meetings. So the model is suggesting, and the futures market is suggesting, that currently we're at 3.78 Fed funds rate, is projecting about 50 basis point increase for the December meeting, or December target, at taking it to about 4.1, 4.2. But then you can see beyond that, the next couple months, it doesn't show these big jumps. It shows kind of a smaller stair-step function. So these rates were higher, these projections were higher a couple weeks ago when everybody was expecting the Fed would keep doing 75 basis points. So if the Fed does 50, that's kind of what the market's priced in. So what could change the deal? So PPI comes out on the 9th, that's next Friday. CPI comes out on the 13th, which is when the Fed meeting starts. 2-day meeting finishes on the 14th. So those 2 important data points are probably the most important things that we'll see before this meeting, and what could happen. So if the CPI, PPI comes in as expected, it's expected to come down, a little cooler, then the Fed would probably do 50 basis points, and non-event for mortgages, non-event for bonds. If the CPI or PPI surprise us and they're high, like we saw a dip last month and it goes back up, then expect pain. Expect the market's going to sell off. Everybody's going to be in turmoil for 30 or 60 days trying to figure out what the Fed's next move is. It's not working. Low likelihood of that, because really what you could expect is kind of the status quo comes in as expected, maybe a little cooler. But if it comes in way cooler, like all of a sudden inflation falls off a cliff, the Fed might really think very hard about what their next move is, because there is that lag effect in their increase in rates. So that would be a surprise. That would probably be a rally in mortgage rates and a rally in bonds. A lot of volatility in either one of those scenarios. The midline scenario would be kind of as expected. So just prepare yourself, prepare your customers. If you have deals in the process and you don't want to take that volatility ride, you know what you got right now. We are in those calm waters. If you get a rally day lock, market's real flat the last couple of days. So, nobody can predict what the future, but we can prepare for, any outcome.
Exactly. And I mean, we've got a wealth of knowledge in you, right? And all of our senior leaders, but we'd love to get your questions and have them featured on the show. So please comment below in the live stream chat or send to communication@benchmark.us. We do love to get those questions answered. That is all the time we have today. Thank you so much, Steve, for coming on the show, and thank you for tuning in. See you all next week on Mortgage Bennett Live.